So to understand the difference between risk and return and why risk might matter more than return in retirement is we're going to take a look at two options. Option A is the equal weight portfolio, and it's probably pretty similar to how a lot of you are invested. It's a balanced portfolio spread out across international stocks, U.S. stocks, real estate, bonds. And it's about 60% risky, 40% safe, 60% stocks, 40% bonds. And it rebalances once a year. A pretty simple formula. And it's a formula that a lot of people have had success with. That portfolio, if we would have started with $1 million going back to 1997, we would end up with about $4.4 million today if we never would have taken any money out. The reason I did 22 years is because most of us, just given when a lot of folks retire, they're going to need at least 22 years of income, so I think it's a good representation. Option 2 is, in this case, it's called the timing portfolio, but it's the exact same portfolio, but it uses a risk management formula. And it's a pretty simple formula. Basically, if emerging markets overall are up over the last 5 months, then we're going to be invested in the equal weight portfolio. And if emerging markets are down over the last 5 months, we're going to get out of the market and we're going to go 100% into intermediate term U.S. Treasuries, which are pretty safe bonds. And so there's a potential that we might miss up on we might miss some upside and we might miss some downside. And we actually see that. We see that the timing portfolio, if we started with $1 million, we would have ended up with $4 million. So we would have ended up with less money. And most people would just leave it there. And they'd say, well, then I want the equal weight portfolio, which would make sense if we're not going to pull money out. But if our plan is to pull money out, we also need to pay attention to this risk factor. So our risk management formula allowed us to reduce the amount of risk we're taking, where we have a 6.38% standard deviation compared to a 9.74%. And unless you're a math PhD, visualizing what standard deviation means to you is hard to do. And so just know that the risk is about 30% less in the risk management formula than in the equal weight portfolio. One number that might be very significant is that we had very similar best years. And then our worst years, we didn't lose 23%. We would have only lost 0.64%. So a lot more people can relate to that. The idea here is that the risk management formula might allow us to have more consistent returns, as is demonstrated by having less risk and having a better worst year. Despite all that, you might look at this and say, well, I still would rather have 4.4 million than 4 million. And I would too. But the reality is that most people in retirement aren't going to don't have money in the market that they're just going to leave alone. They're going to pull money out. And herein lies the entire issue and why I put this together, which is to understand the significance of risk on retirement withdrawals. So let's take a look at what if we were to pull $70,000 a year from our account. If we were to pull $70,000 a year from our account, we actually would have ended up with more money in the risk management formula. You might be sitting there thinking, well, Tyler, how is that? The reason for that is in our risk management formula, we didn't lose as much money, especially in the Great Recession. So the market bottomed. Let's see if we can highlight that. The market bottomed near December 31st, 2008. The portfolio, which only 6 months prior was about equal, 6 months later, the equal weight portfolio was down almost $300,000. Actually, more than $300,000. It was $300,000 less than the risk management formula, because the risk management formula actually took us out of the market and had us in treasuries at that time. And so most people in retirement, they end up, taking their income in the beginning of the year. They take a lump of income at the beginning of the year. They put it in cash. They live on it for the year. And the timing of this all did not work out in the favor of the equal weight portfolio, because December 31st, we're down. We're almost near the bottom. And what happens? Well, we pull $70,000 out. So we lock in losses on almost 10% of our portfolio. If we can avoid that allows our money to last longer. So despite what we looked at earlier, where The equal weight portfolio ended up with more money. If we're actually a retiree and we need money from our account, this shows us the power of consistent returns and why risk matters as much or more than return. I mean, the return's got to be similar. But as long as it's similar, if we start paying attention to risk and investing in strategies that have less risk or in a way that decreases our risk, it means that there's a higher potential that our income and our portfolio will last longer.